Let's break it down. You may have seen a viral claim that Germany just demanded roughly $200 billion worth of gold back from the United States right now, and that it proves Berlin is walking away from Washington. Pause, because the real story is more subtle, more credible, and honestly more important. Germany hasn't issued an official emergency order to haul gold bars out of New York overnight. What we're seeing is a fast-growing political and economic debate inside Germany about strategic independence and counterparty risk. And it's happening at the same time German companies are sharply reducing investment in the US while accelerating investment in China. Now that combination is the signal. I'm Imran, a Middle East-based analyst. And today we're going to unpack what's actually happening, why the gold debate is resurfacing now, how capital flows confirm the shift in risk calculus, and what you should watch next. First, the setup. Germany holds the world's second largest official gold stockpile, about 3,352 tons. A significant share is stored abroad for historical reasons, Cold War logic, Bretton Woods legacy, and practical market access, especially with London still central to gold trading. A big chunk of Germany's overseas stash is held at the Federal Reserve Bank of New York, around 1,236 tons, roughly a third of the total. So what changed? Not the existence of the gold, the politics around it. In late January, German economists and politicians began calling more loudly for repatriation from US vaults, arguing that today's geopolitical uncertainty makes it unwise to keep so much of a national last resort asset under another country's custody. But Germany's government and the Bundesbank have not announced a bring it all home immediately decision. In fact, the Bundesbank has publicly said it still considers the New York Fed a trustworthy storage partner, and officials have warned against inflaming tensions. So why is this debate suddenly back in the mainstream? Because trust is an economic variable. When allies start worrying, even publicly, about access, control, and predictability, the question is no longer, is the gold safe physically? The question becomes, do we want strategic dependence built into our balance sheet? Now layer in the second piece, capital flows. German companies have nearly halved their direct investment in the United States in the first year of Trump's return, according to analysis of Bundesbank-based data. Between February and November 2025, German firms invested about $10.2 billion in the US, down roughly 45% from the same period a year earlier. At the same time, German corporate investment in China rose to more than $7 billion between January and November 2025, up about 55.5% compared to 2024 and 2023. That's not a press conference. That's money moving, and it tells you what boardrooms believe. The US trade environment has become harder to model, and policy volatility is now being priced like a real cost. Now add the third layer, energy dependence, the part that often gets missed. Since the Russia-Ukraine war reshaped European energy flows, Europe's reliance on LNG surged, and the US has become the dominant supplier. In the third quarter of 2025, the US supplied about 59.9% of EU LNG imports. In January 2026, that share was reported around 60%. And for Germany specifically, recent industry reporting suggests US LNG accounts for the overwhelming majority of Germany's LNG imports. This doesn't mean the US controls Europe, but it does mean Europe is living with a new version of a familiar anxiety, swapping one dependency for another. So when you combine these three signals, gold custody debate, collapsing investment appetite for the US, and rising structural dependence in energy, you get a clear incentive picture. Germany is trying to reduce single-point dependencies in an era where economic tools are used as leverage. Now let's talk scenarios. Scenario 1, nothing dramatic happens. The debate stays political, the gold stays diversified across Frankfurt, New York, and London. And Germany continues managing risk through audits, access arrangements, and gradual positioning. Scenario 2, partial repatriation or rebalancing. Germany doesn't panic move everything, but it increases the share held at home, not because the Fed is about to seize it, but because Berlin wants maximum optionality if the strategic environment keeps deteriorating. Scenario 3, the deeper shift, the one people underestimate. Not gold bars on planes, but slow-motion financial decoupling, more investment routed into non-US markets, more supply chain regionalization, and more hedging against US-centric policy swings. So what should you watch next? Watch for Bundesbank language changes, especially on why New York remains important and what conditions could change that. Watch whether mainstream governing parties start treating gold custody as a strategic, not symbolic issue. Watch German FDI numbers through 2026 if the US trend remains down while China stays elevated. That's a durable signal. And watch Europe's LNG import shares, because dependency isn't only about weapons and treaties. It's about what happens when winter demand meets geopolitical uncertainty. Here's the takeaway. The gold story isn't Germany just grabbed its gold back. The gold story is Germany asking out loud whether the post-war trust architecture still holds, and the investment data suggests corporate Germany is already hedging the answer. If you want more of these calm numbers first breakdowns, hit like, subscribe, and comment with what you want next. A full map of where Europe's capital is quietly rotating, or a deeper dive into how policy volatility changes investment behavior.